which often takes on the name of the old paper form, which triggers in our mind a check as though we think of it as just a physical piece of paper. But that's not how we're thinking of it here. We're thinking of the form that decreases the checking account, whether it be an electronic transfer or some other form. Now, notice that we've looked at kind of check forms in the past, which were specialized kind of, or we might have specialized check forms, like paying off the accounts payable, for example. That was a form that we had a bill pay form that we thought about, which is basically just a check form because it decreases cash, but the other side will always go to the liability account of accounts payable. So again, that just by looking at that form, I know what the journal entry is because the form itself tells me. Whereas with a check form, we're going to be paying down the cash. I know that cash is going to go down, but I don't really know what the other side is. And again, sometimes QuickBooks, for example, calls it an expense form, which would lead us to believe that every time we use that form, it's going to be some kind of expense. But that's not necessarily the case either. That term is also misleading to some degree. I could see why they used it, but we could decrease the cash in order to buy an asset. We might be buying property, plant, and equipment. So it's possibly most likely that we use the check or the expense form, which is a check form, in order to pay for an expense, but we might not because we might be buying like an asset, for example. Okay. All right. That said, let's pay some of these off. We're going to say the first one's going to be 126, and then we're going to say we pay cash for insurance. Now, most businesses have to deal with some kind of insurance, such as liability insurance, for example, and it is an expense, but insurance, we're starting off with a funny one, because a lot of times when we buy liability insurance, we might pay for it monthly, in which case it might be just easiest to do to just write it off monthly, and that would be fine, possibly. But a lot of times we pay for the insurance like a year or 6 months to a year in advance because we get a discount to do that. And therefore we have an incentive to do that. And then we run into this problem of, well, I'm paying for the insurance before I actually consume the insurance. A problem we don't have with like the utility bills, the telephone bill, in which case they provide the service first. We've already consumed the water, the heat, the telephone, and are now paying for it based on the calculations of how much we consumed. With insurance, it's not the case. We're paying for it before they insure us. It's also a little bit confusing to know what we're actually getting, because you might say, hey, I don't get anything from insurance unless